The logging sector in PNG has long been suspected of involvement in tax evasion. Instead of turning a blind eye, Commissioner General for Internal Revenue Commission, Koim, initiated over 20 audits since he took office to address the issue. One of the audits undertaken was the transfer pricing tax evasion. Mr. Koim explained that transfer pricing tax evasion refers to the act of manipulating the prices at which goods or services are transferred between related parties or companies within a multinational group. The purpose of this manipulation is to reduce the taxable income of one party, typically in a high-tax jurisdiction, by artificially inflating expenses or lowering revenues. By doing so, the company aims to shift profits to lower tax jurisdictions, thereby evading or minimizing its tax liabilities. Koim said this practice can result in significant loss of tax revenue for governments. It is considered illegal. Based on a risk assessment on the taxpayer had significant volumes of transactions with related parties, did not file Schedule 7 of the International Dealing Schedule, was disclosing annual and historical losses in its income tax returns, and had not paid any corporate taxes in PNG for several years. The main transfer pricing issue uncovered by the audit is that the taxpayer sold log spaces to related parties at prices lower than international market prices, and thus reported a lower income than if its logs would have been sold at arm's length. The IRC performed a financial analysis of the taxpayer, considering liquidity, solvency, operational efficiency, net profitability, and working capital indicators, among others. IRC found out that the taxpayer's financial performance shows a business that is not sustainable, as its liabilities exceed its assets, it is at risk of bankruptcy, its revenues are not enough to cover its cost, it is not a financial position to commit capital to growth and expansion, and it is financially unable to operate on a day-to-day basis. For the years under audit, the taxpayer should have recorded additional revenues of 181 million kina and offset losses of 31 million kina. This implies that it must pay 46 million kina in corporate income taxes to the PNG Treasury instead of claiming losses. After applying a 200% penalty accounting for 95 million kina, the taxpayer is liable to pay 140 million kina. Freddy Mo, TVWAN News.